Hello, welcome to Rise Up, where we take a look at this week's biggest stories. We break them down for you, and we really want to understand what's happening in the market. How do we grow and protect our portfolios? My name's Terri Kallsen. I've spent my life in the wealth management industry. I've been a planner for over 30 years, a certified financial planner. I ran Schwab Retail at 1.6 trillion, and I am the chair-elect for the CFP board. I also have Joe Duran. He's our co-host. Joe has been a best-selling author, a partner at Goldman Sachs, as well as a leader of the largest RIA in the industry as a fiduciary. We also have Peter Boockvar, who is also a best-selling author. He is the Chief Investment Officer for Bleakley Financial Group, and he is the editor of the book report. So very excited to be here. Really, let's get right into the top stories of the week and what's going on. And our first story here is really near and dear to, I know, Joe and I, who are here in California. And it is the California fires in Los Angeles, really taking over the metro area. It is a huge story. We know that 10 people have lost their lives. We also know it's taking a big financial toll, potentially up to 57 billion already in insurance losses, a big issue for California with our state and insurance havoc anyways. And so this is another thing in Hawaii. If you remember the Hawaiian fires, this is 3 times the size of what we saw in Hawaii, which is very, very devastating for both the business as well as the people. So, Joe, I know you're in Southern California. I think about you and your family and your community and the people that you know. Can you tell us about the implications here for investors as well as our insurance?
First, it goes without saying, it's a huge human tragedy. Really something we've never seen before. A lot of these fire damages, brand new. It's really something that started 15, 20 years ago. We did not have catastrophic fire losses in the United States of real property, and it is a growing constant cost. I can tell you as a California resident, we lost our fire insurance capacity in our home here. We have to use something called the California Fair Plan, which is a state registered and a protected insurance policy. However, it's limited to 3.5 million. And many of these homes in the Pacific Palisades, $6, $7, $8 million homes, they're not going to have enough coverage. A lot of them were dropped by the insurance companies. So 3 things to think about. Number one, the loss, if you haven't got enough protection, what does it mean to you as a planning challenge? Number 2, what happens with insurance costs going forward, and what does it mean for investors who own insurance companies? And third, what do you do if you're a California resident or if you're in an area like Florida when insurance rates become untenable for a lot of people? And so there's the investment question, the issue that happens for you as a human being with a home, and then what do we do as a society? Because this is a growing threat. I know some people don't believe in global warming, but fire, the kind of catastrophic loss, is a brand new thing that's happened really in the last 20 years.
Yeah, that's so true. And Peter, I know, New York even had fires earlier this year. What are your thoughts on this?
Well, I just want to add to what Joe said. I mean, he touched upon all the important points and just how tragic this is. Also, the other issue is for those that lost their homes in the situation of the cost of rebuilding and even trying to get insurance. Do they even bother? Do they want to stay, or do they just go somewhere else? I also think that California, which needs to liberalize somewhat the economics of having insurance there in terms of being a business and economically making it viable to stay there. So hopefully they can invite more insurance companies to compete for business that can cover these things that were not previously covered because a lot of these companies had left. I think in the scheme of things, we'll have to see how commodity prices respond, the price of copper, the price of lumber, because rebuilding is going to be hugely expensive. Particularly in light of this post-COVID situation where just the cost of a lot of different things, labor, raw materials, land, and so on, has risen so much.
And I'm just saying, California alone, building costs are very, very high. Getting coding and business permits are really difficult. And so you already have a constrained construction market. So bringing in enough contractors to do the work, getting the government to not make it so difficult to build, which is very difficult in California. And then you're in an area that it's not like the hills are going away or the trees are going away. We're still going to have continued fire risk. as Peter mentioned, a lot of people are going to decide they don't want to move back. And these areas are not blighted. The Pacific Palisades has no shopping centers. The houses that are standing are in avenues and blocks without any homes. And so there's even talk now that BlackRock is thinking of coming in and investing and buying all the land. And so it's going to reshape Los Angeles. It's also going to have all kinds of implications for people locally, for rents that are going to go exorbitant in California because you have thousands of people now looking for homes. And the neighboring states where a lot of people are going to throw their hands up and say, I don't want to be in California anymore. I'm moving to Arizona or to Texas. And so, again, big catastrophes like this can have an accelerating effect on the things that are happening already in the economy.
Yeah, Joe, I used to work for one of the largest property and casualty insurers in the country. And on one side of the building, we had financial planning and investing. On the other side, we had the P&C group. And we were always managing, market meltdowns during that process, catastrophic results, not only just in the market, but when you have something like this, it takes a tremendous turmoil within that insurance company to make sure everyone's covered and they've got vans out there helping these people. So
and look, insurance companies in Sweden are not all that popular because they take a hit now, but you can bet that they will be increasing premiums and protecting themselves and even outright dropping insurance as they have already in Florida for floods and fires.
It happens in California as well. On the coast, it tends to be where we drop people from insurance.
That's correct.
Well, let's go to the second biggest story, which is the Fed minutes this week really revealed that, we're going to have a slower time in terms of cutting rates. There's real concerns over future policy moves. And the market is telling us that, right? The U.S. added 256,000 jobs in December, which was much more than expected. Unemployment rate has dropped to 4.1%. And then we did have a volatile stock market, as we know, where the U.S. stock market was really only down about 0.5%. This all impacts stock prices. The 10-year U.S. Treasury yields hovering at about 4.75%, which we haven't seen since April of 2024. Hey, Joe, can you give us what your long-term and short-term impact is on this?
Well, I'm interested to hear what Peter has to say on this. I have a view. We're in an inverted yield curve, which means that the 10-year bond was lower than the 2-year bond or the Treasury market, which implies a recession typically. That was not the case here. What we're actually seeing is the economy is actually doing just fine. And that means that the Fed is probably not going to reduce rates as much as everyone thought. And in fact, we now have a positive sloping yield curve. The 10-year yield is around 4.7, 4.8. Treasury is around 4.3, so it's a small lead. But typically, in a normal economy, you have about a 1 to 1.5% spread between the 10-year and the 1-year, the 60-day money, which implies that we could cross 5%, 5.5% if we don't drop short-term rates a lot. So if we get stuck at 4.2, 4% with the Fed, that we could see the 10-year go to 5, 5.25, which of course makes mortgages more expensive and has all kinds of implications for stocks. So I think the stock market's been quite muted so far, but you have seen VIX trend up to 20, which for me gives me concern. Peter, I'd love to get your thoughts on what this all means, you think, for investors.
Well, the very interesting dynamic is as the Fed, which they started in last September, cut the short-term interest rate, the overnight rate, by 100 basis points, the 10-year yield since then has risen by 115 basis points. So in a way, on one side, the long end of the yield curve sort of disagreed with the Fed's belief that the economy needed rate cuts. Inflation has been decelerating, but the key for the Fed is not seeing a decline in inflation, it's seeing a sustainable decline in inflation. And rather than waiting to see the sustainability of it, they cut 100 basis points. But the rise in long-term interest rates is not just a US phenomenon. We've seen it all around the world. We've seen rates jump in Japan. We've seen rates jump in the UK, in France, in Germany, in Australia. It's a global phenomenon. So it's something to keep in mind that it's not just a US event, but it does complicate the economy, and that higher interest rates for longer is a real thing. And it's something that the economy will take time to absorb because every day somebody's loan is coming due. And the rate on that loan was likely priced before 2022. So there's still this digestion phase in this new higher rate environment, I think, that we need to deal with.
And you think of mortgages, they're sitting today at almost 7% for a 30-year mortgage now in some cases. So that's very different than where we were 2 years ago when you could get a 30-year bond for a couple of percent, 2.5%, 3%. So, it makes home pricing interesting enough. Home prices haven't adjusted to reflect that, but it makes it a good alternative for investing in stocks. And that is a very important element here. If your alternative is to get 4, 5, 6% with fairly secure treasuries, that makes investing in stocks comparatively less attractive. And that means over time that a stock market can be more volatile. And that's what we might see this year, is a really heightened sense of volatility because of what is going to happen with interest rates.
Yeah, I
and
couldn't agree more.
just to add to that point, valuations matter when rates go up. When rates are low, investors can be very valuation agnostic. But as rates go up, high multiple stocks become more sensitive to that rate move.
That's great. I want to get to our third story now, and this is a pretty important story. And I know it's only mid-January, but we've got Valentine's Day coming up. And what do we buy for our Valentines over Valentine's Day? What do you guys buy usually?
Chocolate.
Chocolate.
Right?
That's right. So I'm a planner.
Chocolate addict.
I have
Yes.
3 daughters, so it's
All
lots
right.
of chocolate in this house.
I knew it. So, I'm a planner, so I start thinking about costs and pricing. And you guys probably saw that Bloomberg announced today that Hershey's, who is, cuckoo for cocoa, they're really asking the CTFC for permission to buy a large amount of cocoa through the New York Stock Exchange because of the global shortages of chocolate. I mean, there's a global shortage. Ghana, the Ivory Coast, this has been going on for several years. So, all those Reese's peanut butter cups, the Hershey's Kisses that we're going to buy, Michelle Buck, who's the CEO of Hershey's, is saying, I want to buy 90,000 metric tons of cocoa, which seems heavenly to me, but maybe a very difficult decision. So, I'd like to just get to, what's the impact here in terms of the pricing of cocoa, and how should we be thinking about this, Joe?
I think it's a measurement of what's happening in the rest of the world. What they're doing is basically buying futures. They're protecting themselves for the price increase of chocolate. When prices of chocolate go up, you bet they're going to pass that on to consumers, but they will get profit margins as a consequence of that. It also means that if chocolate prices do go down, anyone who's buying Hershey's product won't get to benefit from the reduced pricing. So what they're doing is managing what they think is the right time to buy an asset class and protect their costs into the future. And again, you see it with oil companies all the time. It's protecting basically their inventory because it's their biggest use product. And so if they can manage the cost, that doesn't necessarily mean it's good for consumers, but it's certainly a protective move by the business to ensure they can get chocolate at a knowable price, and therefore they can set the pricing for their own products with some level of predictability.
Yeah, I agree. Peter, what are your thoughts?
No, that's right. Now, cocoa prices are basically at record highs. They're up substantially over the last couple of years because of the supply issues, Terry, that you had mentioned. The thing that Hershey's trying to do is, because the CFTC has limits on the amount of purchases that one buyer can make. So that's why Hershey's making a special request to sort of exceed that so they can create visibility for their own business in terms of what their raw material costs will be for the period at which they want to purchase this at. So they are protecting their cost structure here against the ever-rising price of cocoa.
That's right. I get a little nervous about the next couple months because I hear the prices of champagne are going up, the prices of wine are going up, and now chocolate. It's like the trifecta. So hopefully we'll be thinking about this as we plan for additional costs for Valentine's Day. But let's move on now. Let's get to the 3-question segment. This is where we really take a deep dive into the questions our viewers, all of you that are sharing with us. And the topic this week that seems to be of a lot of interest to our viewers is that, President Trump is talking about taking control of Greenland and really thinking about tariffs potentially, and he's not even ruled out military action. And so we do have one question that came in from Mario from Guatemala, and he wants to know, what would Trump even want with Greenland? Peter, can you take that one?
Okay, so putting aside his desire to sort of annex Greenland and all the implications that comes with that, The thought process is that Greenland is in a very strategic place geographically, but also has very important raw materials that both China and the US are trying to get their hands on. China is a dominant producer of rare earths. Greenland happens to be rich in rare earths. Also, graphite is a very important raw material that China makes a lot of, that we need more of, and that Greenland has a lot of. So it's the raw material commodity side that Greenland has that theoretically everybody wants to get their hands on. That, in addition to the strategic positioning of the country relative to the rest of the world.
And I'd add on this subject in particular, China has been doing this, not overtly. They don't take over Zimbabwe, where I grew up. But if you go to Zimbabwe, you will see the Chinese have taken over the manufacturing and mining of almost all minerals. They're doing that with soy in Brazil. What China is doing is creating strategic partnerships in countries where they are agnostic to the politics to source raw materials directly and indirectly by providing other services to those countries. So if you go anywhere in Africa, and I just returned after the holidays here, you will see the incredible presence of China all over the emerging world. And so I think this is Trump's message about, hey, we've got to get smarter about getting resources that are not available here in the US, one way or the other. Now, whether he does that with Greenland or not, and it becomes Trump land, I don't know. But I do see that he's sending a message to China. We're not going to be blind to the resource battle that is happening in the world.
Yeah, I think that's important. And another question we received from Dave in New York City, he's really wondering, how does this tariff even work? And is it even possible based on Trump's assertions?
Well, let's start with what a tariff is, because there's a lot of confusion about what tariffs are. A tariff is a tax that's placed on a product when it is imported into the country. And let's just use something simple. If you bring in a car from Mexico and it is manufactured there and you put a 50% tariff on, when the car arrives, the person who imports it will pay an extra 50% to bring that product in. They'll pay that to the US government, but then the cost, of course, is actually paid for ultimately by the consumer, because the manufacturer who brought it in is probably going to charge that to the consumer. They're not going to eat it all. They're not going to be able to. The goal is, of course, to manufacture locally. In the case of Denmark, maybe we'll tax chocolate again. I think that's what they make there a lot of. Clogs is another thing I think they make, but I'm sure there are other things. I know they used to make a lot of cell phones. It just is a way of asserting your will if they want access to your market. Of course, those countries also have the ability to tax back, to add a tariff in return. And that's typically what happens. Tariffs usually beget more tariffs and are usually inflationary, especially in the short term.
Yeah, that's great. I think another big product Denmark is now really well known for is Ozempic. So they're really controlling.
It'll make a lot of people unhappy here in the US, I think.
Yeah, I think we'll catch up though.
Yeah.
We have one more question from Maddie from Tucson, Arizona, and she's really asking, what should I be thinking about overall, not just Greenland or Denmark, overall about my investment portfolio based on these tariffs? What steps should I take? And we'll go with Peter.
Well, it's tough to say in a broad perspective, because we don't know whether the tariffs are going to be very strategically and selectively placed, or is it going to be very broad-based. 2017, 2018, it was very much a scattershot approach, and we tariffed a lot of different countries on a variety of different items. And the repercussions, though, was in order to protect some US domestic producers, manufacturing, generally speaking, went into a recession. So it all depends on where one portfolio is positioned. If you are heavily dependent, if you're a business that's heavily dependent on imports, then you can get negatively impacted by that. If you're a service business that is making a movie, for example, or has a restaurant sourcing food products within the US, well, you may not be affected. So it depends on the complexion of the tariffs, how widespread it's going to be, and who it's directly going to face. But I think generally speaking, there is going to be at least a one-time rise in prices in a variety of different items. That inflation could impact interest rates. Interest rates could impact the stock market. But I would recommend just taking more of a wait and see until we get more details rather than doing something prior to that.
Yeah, Peter, I think
I
that's
totally agree
something.
with that.
Yeah, I think it's something we can continue to address in these sessions because we're going to learn more and more each week. It's going to have an impact. And so I think our viewers can continue to get more knowledge to make better decisions about their investments.
For now, honestly, the threat of tariffs is creating uncertainty in the markets, and uncertainty is something the markets don't like. So we don't even have President-elect Trump in office yet. Once he's actually in office, we'll see. I already see that the idea that we're going to cut $2 trillion from the budget. I saw Elon Musk now saying, well, it's probably $1 trillion and we'll be lucky to get to $2 trillion. Well, that is a pretty meaningful difference. We're going to see there'll be some softening of positions. There'll be some hardening of some positions. And as that unfolds, we're going to be talking about what you do with the portfolio. For now, the biggest impact, as Peter mentioned, is interest rates. So right now, we're seeing interest rates stay higher for longer. We're seeing the 10-year go up. That's making risk assets less appealing. And that creates an environment where you want to be in more conservative, risk-reduced equity. And you want to think about rebalancing your portfolio because we're probably going to be having higher volatility. So in answer to that, I think you said, Maddie, I would say the one thing I would do is just look after last year's big increase. Do you need to rebalance your portfolio? Because it's quite possible that your stocks went up a lot and that you now have more in equity than you're comfortable with. And you went from a 60-40 stock to bond mix to a 70-30 mix. And that means without not wanting to, you now have a lot more exposure to market volatility. So I would start right now. The thing you should do this minute is take a look at your overall risk profile on your portfolio and make sure it's actually in line. If you have an advisor, they can do this for you in 5 minutes. Like, what is my current allocation and my risk exposure if the market was to fall? So that you're not overly exposed to equities in what could be a very volatile time here.
I think that will help our viewers really face the volatility that we know is coming. One thing we're certain of is there will be more volatility. It'll give them the confidence to be able to withstand that over the next 6 to 12 months. So great advice, Joe. Okay, Joe, that certainly leads us into the next step, which is the big three for next week. What can we expect in terms of discussion for next week?
Well, next week's going to revolve around three things. First, most importantly, probably what's happening with the big economic reports that are coming out. We've got data releases, U.S. retail sales, CPI. Obviously, inflation is a big, big watchword. What happens with interest rates? So watching what happens with interest rates and the data that comes out next week. Second, I'm really interested in Bitcoin. Bitcoin is basically a binary bet. Is it legitimized or not? And early on, the incoming administration has been quite vocal in supporting Bitcoin. As the talk becomes a little bit less positive about it, we're seeing some volatility. And so we've gone from over 100,000 down to low 90s. We're trading right now around 95,000. And at the end of the day, this is a very expensive bet. If it gets legitimized and it becomes a currency you can use to buy cars and everything else, then this asset will be more valuable. The question is, will governments actually allow it to remain a hard to trace, hard to tax asset? And right now, what we're seeing is it's easy to invest in. It's made easier now because of ETFs. We don't know really what the underlying value of Bitcoin is because we don't know if it's a real currency that you can use. And I think, again, next week, we're at this inflection point right now where we're either going to break that 104,000 per Bitcoin, or we're going to drop below that 80, 89, 90,000. And that could be, a correction time where we go down to 70 or 65. And so I think we're right at that point right now. The volatility has been converging. Next week could be a point at which it triggers one way or the other. I know, Peter, you're looking at earnings, and there's some big earnings next week. Which ones are you most interested in?
Yeah, it really starts to accelerate at the end of next week when we hear from the big banks, JP Morgan, Wells Fargo, Citi. We want to hear what they have to say about loan growth. Loan growth has been very muted over the past year. And also want to hear about their customer, both their business customer that is borrowing at higher rates, and also the consumer that has seen rises in delinquency rates, particularly the lower end consumer relative to the upper end. So I think it'll be a good sort of finger on the pulse of the economy as we then pick up the earnings reports in the weeks thereafter.
Thank you so much, Joe and Peter. And thank you to all of you viewers who have watched. At Rise Up, we're just getting started. We'd love to hear from you. What types of questions do you have? What do you want us to cover? What do you don't want us to cover? And really just send us in any feedback, because we're happy to address all of it. I really want to thank the team, Peter and Joe, all of you, and we'll see you again next week.